Federal Bank is the first one. They've had a number of issues to contend with. Kerala floods leading to additional slippages in quarter 2, which may rise in quarter 3 and quarter 4. But as per the management, and then came INFS, and the bank has exposure of 200 crores to these 3 INFS projects. Now comes the RBI with its new lending rate framework, which bankers say may cause short-term disruptions as well. So what's the plan now at Federal Bank? Let's put that question to the MD and CEO, Shyam Srinivasan. He joins us right now on the show. Mr. Srinivasan, good having you. Thanks so much for joining in. First off the bat, we've of course spoken to bankers yesterday as well, but this whole benchmarking and what it would do to loan portfolios, because I think for a lot of commercial vehicle or auto loan portfolios, the probably rates might be fixed as compared to home loans. But in home loans with a longer or larger tenure, etc., there might be a variance in the way banks have given out loans until now and will have to give post-April.
Yeah, morning, Neeraj. Yes, this development is quite fresh, but I think the banks will have to readjust to a new reality. Floating rate deposits is obviously an option, but the market for that is not established. B, we don't know how deep it is. So one has to figure it out. Having said that, as you pointed out, this will largely apply to assets in the home loan space. The big question being, these are very long tenor assets. So one has to figure out how this is going to happen. It may have some near-term system-wide implications, but there have been many such challenges which have sort of handsomely overcome. Point would be which external benchmark and what is the spread above that. As long as there is some sanity in the spread, then it's an addressable issue. But if an institution, if they're a leading player, start playing with the spread, then it will have a market-wide implication. So I'm making no judgment. We just have to wait and see how things play out. But it's a development which is quite different from anything that's happened in the near past.
Yeah, let's see if the retail investors are a lot more happier than bankers, Mr. Srinivasan. But yeah, I think it's difficult to gauge as to what the impact would be right now. Let's talk about Federal Bank then. We didn't get a chance to talk post quarter 2, but if I just look at what's happened, there's a bit of a dichotomy in the way I perceive things, Mr. Srinivasan. Your guidance of 1400 to 1500 crore slippage probably implies a lower slippage ratio, despite the fact that I thought that in some conversations, the message came out that slippages could actually get exaggerated in quarter 3 and quarter 4. How do you think the picture would look? You would have had some sense of how quarter 3 would look like because, well, 2 months have already passed by.
Like I've been mentioning, we are not changing our overall guidance. We're very much in that range. Beyond that, I have really no incremental comment to offer than what I said in August, almost immediately after the floods, and at the end of our Q2 results, the commentary we shared. I think we are trending along those lines. We still believe that 1450, 1500 overall slippages is very much within the ambit of how we are progressing this financial year.
So, okay, I'm not looking for an additional comment, but just wondering if that's the number that we are working with, Mr. Srinivasan, then the slippages ratio should probably look a bit better than what the street might be working with right now.
My inputs remain the same, Neeraj. I'm refusing to make any incremental input on this.
Fair call. Just wondering if things have stabilized a lot more post the Kerala floods, now that there is some time and some time for recovery that would have come in as well. One, for the business sentiment out there, because you would be a barometer, and two, for the lending community which caters to that market.
I think the key point which we mentioned, rather mentioning all through, not only federal, most of the lenders would agree. The client sentiment behavior on the borrowing and repayment side, for most customers who have some commercial or salaried, they haven't been tremendously damaged. Having said that, the life and livelihood of people who live along the path of where the water was maximum, those people have had to readjust to a different life and are trying to come to terms with it. But that tends to be typically less the bank customer who's taken big loans. They are a more livelihood in the area of farming and other day-to-day wage earners. So to that extent, the impact on banking per se has been, or I would think most of us would say the same thing, more or less dimensioned and playing to that script. Having said that, are the restoration work in those areas, are people coming back to life? A lot of work is going on, but I guess there's lots more to be done. And we as a good corporate citizen are doing our parts in every part, because some of that is in and around where we live and work. So we've taken up those communities for help. So it's a two-part answer. The commercial and business conduct, I would say, is more or less on track, except for certain pockets. The physically impacted, people who have lost lives and livelihood, there's a lot of effort, but I think that has a different kind of social implication, less commercial implication.
Okay. Well, one only hopes that both the social and the commercial pictures improve more dramatically and more quickly than what everybody would anticipate. One other big change that's happened, Mr. Srinivasan, for almost everybody in the financial space has been the recent IL&FS issue and the NBFC crisis resulting along with. Now it opens up areas for banks which hitherto were completely dominated by or largely dominated by NBFCs. My question to you would be that would you benefit materially in the areas that you operate in because of some NBFCs going a bit slower because of constraints of capital? And two, if indeed those opportunities have risen already, if you need funding, would you look to maybe issue more corporate deposits or otherwise in the near term in order to be able to fund that loan growth?
Neeraj, I recall you mentioning that for 5-6 quarters our credit growth has been quite good. We continue to be on that stream. Growth is strong. We don't want to pick growth that is on the edge. Our ability to fund that growth is quite robust. Our CD ratios are in control. Our liquidity opportunities are significant, as is capital. So I think for us, growth is not constrained by liquidity. It's constrained, if at all, by the appetite we have. And we're quite selective about where and what we grow. That said, the recent opportunities that have come up on account of slowing down of some of the NBFCs has given us pickup on the retail side, but retail end customer moving to federal. The last 2 months have been quite spectacular for us in some of our geographies where we've seen good growth, and I think that will continue. But that's not a buyout of a portfolio. It's client moving for various reasons, and I'm happy that they're moving to us versus somebody else. So yes, there are growth opportunities. We're not constrained by either capital or appetite. Wherever it's good, we have started growing. We are seeing growth. And we are giving a conscious twist to the portfolio also to balance out between a more corporate heavy to even balancing between corporate and retail. That's how our shift is, and you'll see it visible in the coming quarters.
Okay. My final question, Mr. Srinivasan, and that's looking at what excites you the most. Now, you're obviously looking at a run rate of about 10 million customer mark very, very quickly, and you'll probably look to cross-sell a lot of your products there. You've beefed up your personal loan portfolio, if I'm not wrong, an analytics team to kind of look at that product too. What area or what vertical within few multiples that you're operating right now is showing the best promise for growth for the next 3 or 4 quarters?
Again, because of base effect, areas like personal loans and even auto loans, where our current base is very small, they are registering over 100% growth, which is great. But on the balance, if I grow from 500 crores to 2,000 crores, it's still only 1,500 crores increase. It may look like 300% growth. On 105,000, 110,000 crores, it won't show up as a large number. But areas like personal loans, auto loans, and commercial vehicles are turning out to be very attractive for us. These are new forays of the bank. While we continue to strengthen our mid-market and commercial banking businesses, which thankfully we've introduced a lot of capabilities and talent. So we are seeing pickup across. But I'd like to see the overall weight of the book, which is currently 55-45 wholesale retail, to get to 50-50 over the next 2 years, which means the points I mentioned. Areas like personal loan, areas like commercial vehicles, areas like auto, all that have to kick in at a higher run rate so that the blend shifts 50-50.
Okay, we wish you all the best for all of those as well as for the asset quality stability, Mr. Srinivasan. Thanks so much for taking the time out. Look forward to talking to you post your Q3 numbers.
Thank you. All the best.